I think more importantly, you have to have a plan about what you're looking for and what you're going to do if something starts to go wrong. Okay, so that when it happens, you're ready, because I don't think you're going to be able to anticipate it. Like I said.
Thanks for joining us for part 2 of our interview with money manager Bill Fleckenstein. And if you haven't already watched part 1 of our discussion with Bill, head over to our channel at youtube.com/Wealthion to watch it there first. It sets the context for the investing perspective that Bill and our partners at New Harbor Financial share in this video. Oh, and if you haven't already done so yet, please take a second to subscribe to this channel by clicking the red subscribe button below. All right, and with that out of the way, let's get started watching part 2 of our interview with Bill Fleckenstein. But in terms of allocating capital, do you feel like there's enough confidence that, hey, we can still, you can still sort of ride the momentum with a safe enough risk to return ratio? Or are you more in just sort of like hey, defense is probably the prudent thing to do at this point? Do you have an opinion right now?
Yeah, I mean, for the last group of years, actually, I have felt that you could own precious metals because they would be beneficiaries of these policies. Now, they don't benefit every day in the same way the SPOOs go up every day, but at least you know that you have a call option on the consequences of the policies the Fed has pursued. So if we're going to have more inflation, precious metals, ought to do well. They've been going sideways to down since the peak last August or so. And the sentiment is really quite poor. But then if you look at the mining companies that pull the metals out of the ground, I could show you, 6-8 stocks that I own. One's about 6 times earnings. The other ones are 8 to 10, 12 times earnings. They have growth, they have dividends. And I believe that, at those valuations, you don't have a great deal of risk. They don't trade on their valuations at this moment in time. They just trade with the metals. But for me, I feel like I'm buying things at 1980 style valuations that are the perfect beneficiaries of the policies in the period we're about to go into. So every time so that's what I've chosen to do. I own a couple of other types of companies as well, but that's where I feel like I have the best risk reward, and I've got all the macro going in my favor.
All right, great. And after we say goodbye to you here on this program, and by the way, thanks for giving us so much of your time so far, Bill. This has been a great conversation. We're going to talk with the lead partners of New Harbor Financial, as we do every week. And I think they owe you some little kickback, Bill, because you just teed them up for they're actually quite focused on the precious metals mining space.
Well, so. I think that's the right place to be. So, and yeah, thanks, guys. The check cleared.
Yeah. All right, Bill. So let me, as we begin to wrap up here, and look, I feel like we could go on for another hour, but I want to be respectful. All right, you talked about the precious metal miners. The general question I've sort of been leading up to is, what would your advice be to today's concerned investor who's looking to, prudently grow their wealth in this risky environment we've talked about, but I think ideally wants to preserve their capital even more, they want to make sure that no matter what happens, they don't become collateral damage if we end up hitting that iceberg sooner rather than later. Okay. So you mentioned the miners. What else might you think they should look at?
Well, I think, the way you're going to be able to protect yourself is by your overall asset allocation, I think. And so you can have the amount of exposure to the miners, for instance. Each person has to figure out, well, I mean, do I want 5%? Do I want 40%? I mean, it's all kind of personal in what you think and believe. So there's that. The more concerned you are about the near-termness of the iceberg, so to speak, to use your analogy, would mean you just have to hold some cash. And how much cash would be more a function of maybe your age or your level of angst. So, the cash is the real defense mechanism that you would have against that. And then I think more importantly, you have to have a plan about what you're looking for and what you're going to do if something starts to go wrong. Okay. So that when it happens, you're ready, because I don't think you're going to be able to anticipate it. Like I said, you're going to have to recognize, oh, something's different now. And I need to get either less exposure i.e. more cash, or I need to own some puts or something. So I think having a plan before something goes wrong is a very good thing to do. And that way you're prepared, because you can't act too early if you're going to try to be defensive. Now you can have more cash, which you can't get hurt by, except for the fact that the purchasing power is deteriorating, but it's not going down that fast yet. So I would say some combination of miners, cash, and then having a game plan for what happens when things go wrong and what am I looking for to know that something's gone wrong. So I think the market, because of the way the structured products are and the way the passive investments are, it kind of has to get weak first before it can get really weak. Otherwise, barring an exogenous variable, it kind of stays in this band that's got an upward tilt to it. And so that would be that's how I'd answer your question.
All right. Well, great answer. And with miners, cash, and a plan to be able to react to the unfolding market conditions, I figure it must have been a hell of a check that the New Harbor guys sent you. That's pretty much their script. That's great. All right. Well, look, as we wrap up here, Bill, first off, great conversation. Thank you very much.
Yeah,
I'm
thank you.
Big fans with folks that are close with you, Grant Williams, Stephanie Pomboy, that crew. So it's so fun to have you on, along with them. You guys are just all really dynamic thinkers and are helping educate a ton of people. I would love to invite you back on the program at some point later in 2021.
I'd be happy to. This was really fun. You asked great questions, and I'd be happy to come back anytime.
Well, thanks. As we leave, I'm going to unfairly ask you two questions. One, I said I wouldn't, and I'm just going to be a jerk and ask it anyways. It's not the when question per se, but could you give me a time frame, just gut check, that if the status quo hadn't met with some sort of reckoning, it would surprise you? Can this continue another 5 years, another 10 years, or do you think we're destined to?
No, I don't think it can continue 5 years. I think that this year we're going to have problems in the bond market. And my shorthand expression is the bond market will take the printing press away from the Fed. And what I mean by that is what I sort of described earlier. And I think because of the inflation data and all the things that are going on, I think they're going to have a problem. Now, what's going to happen is the inflation data is going to run hot, as it has. And most people are quite sanguine about that, because most people in the business, most of the people in the investment business have been there for less than 25 or 30 years. And you have to be like sort of my age, your age. I look quite as old as me. So to have any experience with that. And so I think that the consensus viewpoint is right now, inflation is going to be hotter than people think, but we all know that it's transitory, so don't worry about it. I think we'll have a period where people will start to worry about it and think it's going to last longer. That may be when we see yield curve control, but some combination of higher inflation and people starting to understand that it's not going down. It's probably going to get out of control. Now, out of control doesn't mean it's going to 10. It just means it's on the loose and it kind of can do what it wants, and the Fed is powerless to stop it. I mean, they talk a good game, but my God, these guys are so pathetic. They'll never do anything, because the stock and bond market will collapse if they tried to get aggressive. So I think sometime between now and September, there'll be a problem in the bond market, and if they have to resort to yield curve control, when that happens, that's when you have to start paying close attention. That's my game plan at this juncture.
All right, great. Well, if we can, when that happens, I won't say if, when it does happen, would love to have you back on the program. So as it becomes the time to pay attention, you can help call a couple of audibles for our viewing audience here.
Fair enough.
All right, and last question is just for people that have really enjoyed this conversation and hearing your insights, where can they go to learn more about you and your work?
The column that I write is, as you noted earlier, is at fleckensteincapital.com. And it's a pay site, but I have kept the price, really low so that anyone can afford it. It's $120 a year. Or maybe it's $130. I can't remember. Anyway, and I write a daily column and I answer questions.
Great. You're also quite active on Twitter, right?
Yeah, I'm there. It's at Fleckcap. My activity is kind of episodic. I mean, I get busy and then I don't say anything, but yes.
All right, great. Well, look, in the editing process, we will put the URLs to both of those up on the screen.
Okay.
And with that, Bill, I'm going to say thank you so much for giving us so much time and really so much expert insight into trying to understand what's going on here. It has really been a fascinating discussion. Thank you.
Well,
Thank you.
as I said, thanks for the great questions, and I enjoyed myself, and I'll come back anytime.
All right, great. Thanks so much, Bill.
See ya.
All right, Mike and John, geez, just another great interview. Bill Fleckenstein, what a great mind there. All right, let's quickly, in the last couple minutes we have here, first I want to get your guys' reaction, and please tell me, how big was the check you guys wrote him? John, why don't we start with you?
Yeah, no, we really appreciated Bill's comments. I love, firstly, his humility. We in our seats know that we always have to have a healthy dose of humility. These markets in general, but especially these markets are here to frustrate, torture, all the above. So humility is an absolute necessary. So I loved his, even though he has, in his career been a, prolific short seller, he has the restraint to look at these markets and say, now is not necessarily the time to do that. So we like that restraint. We didn't write him a check at all. I think he probably looks at data that we look at, and it's pretty easy when you look at the data to kind of come to some places like we have with, a logical conclusion that cash and some mining stocks and a whole lot of patience basically is probably the best place to be, and that's certainly how we view markets and how we're counseling our clients.
Great. Mike, I'll let you chime in there, and then I got a question for you about market activity. So why don't you start, and then I'll jump in.
Yeah, I mean, he called this market an epic powder keg, but it's impossible to tell when it's going to turn. It is an epic powder keg, and it is all based on Fed intervention. It's all about. It's been that way for years. And it is frustrating for the individual investor or the professional money manager to navigate that. We have not been short or net short for our clients, thankfully, because it's the turn has been really impossible to time, and already it's gone far beyond where we think it could have. Valuations are absolutely absurd, beyond compare, across the board. All sectors of the market, all tiers of the market are far beyond previous highs of 1999 or any other thing to compare. So it is all about just, waiting for that catalyst. Everyone wants to know what the catalyst is. Nobody is going to know it ahead of time. They want to know when the turn is. Nobody's going to know it ahead of time. Bill talks about reacting after the fact. That's pretty tricky too, because how many times in the last few years have we had a 3, 4, 5, 10% correction that was only immediately reversed right after? A lot of people got hurt doing that, entering on shorts with those signals. So we kind of think that there may not be a catalyst, there may not be any signal, they don't ring a bell at the top, and we probably will see a very swift correction once we see the first one. It could be 20 or 30% in a matter of a couple weeks' time, similar to what happened last March, and maybe this time it doesn't come right back. So, the logical thing is to have a very heavy cash position, and we have mining stocks, as the viewers know, we've had for quite a while with hedges. And a couple other tactical things, including oil stocks. We still like oil here for the low valuations. It's still somewhat out of favor and pays a good dividend. But patience, the last word I'll say, patience. It's extremely hard. We could talk all day long about the Fed and game theory, but the truth is just sitting tight and waiting is what needs to be done. And looking back in this seat to last March, 13 months ago, it feels like 13 years. It's hard. It's hard for everyone to wait, but that's what needs to be done.
Yeah, I just had a discussion earlier today with somebody who was, sort of saying, hey, you guys have been recommending defense. How can you do that in a market that's been, as hot as this one currently is, right? And it's just the whole FOMO thing that we talked about last week. And, in the discussion, I basically used your guys' performance from last year when, the March swoon hit. To your point, it was a violent, instant correction, and within just a couple of weeks, the market was down over 35%. And I remember interviewing you guys on a day when we calculated, okay, the overall S&P was down negative 35%, but your portfolio was up 1%, and that is where the patience pays off, right? It's not fun to exercise the patience when the party is going on, but I will tell you, the second the party is over, everybody who's been throwing caution to the wind is scrambling, trying to get in the door of advisors like you, because that relative outperformance is so dramatic, and they're all of a sudden instantly burned, injured, scared, et cetera, and they're just trying to turn back the clock, and of course you can't do that. So I got to commend you guys for continuing to toe the line on patience, and I'm glad that Bill really underscored the fact that it now is a good time to be in cash and to develop that plan so that when the better valuations come along, you've got that dry powder and can deploy it. But look, that time is not today. Looking at the markets, all the major indices are back at their all-time highs, right? So the party is still continuing to go on. But last week we talked about some signs that it might be petering out. And I do want to shine the light just on two quick anecdotes here. One is that Coinbase, the largest cryptocurrency exchange, to much fanfare, went public yesterday. And everything crypto has been on fire for the past year, but this has been a disappointment so far, right? It opened up in the 400s yesterday, and last time I checked the stock price, it was down to like the 320 range or something like that. And that may be a sign that you sort of hear the buy the rumor, sell the news. This may be one of those events where everything that could be priced in has been priced in, right? And definitely cryptos have been one of the biggest story elements of the current mania. And then secondly, one thing that's been driving a lot of the froth of late has been the issuance of all these SPACs, which are basically a way to circumvent the IPO process and to bring companies to market much faster and with a lot less regulatory scrutiny, again underscoring something that Bill was talking about. And the SEC, very uncharacteristically, just threw a big monkey wrench into the SPAC process where they're changing the accounting rules, and as a result, pretty much all SPAC issuances have frozen, at least until the government gives more clarity on how it's going to treat these things. So I'm just asking you guys, do you have a sense maybe that we are beginning to see the tenor of the party atmosphere begin to shift here? John, let's start with you.
Yeah, I think that very well could be hallmark signpost there, Adam. I mean, I think we just talked about the lack of regulation and the sleep at the wheel by regulators. So, we can go back several times over the last, look at the housing crisis, look at the absolute sleep at the wheel when the rating agencies were essentially captive by the issuers of these, toxic mortgage bonds, but yet they were stamping them AAA because they wanted to get the rating fees. Blatant example of regulatory capture and absolutely regulators not doing their thing. And they always do it after the fact. They try to clean up the mess after the fact. And I think this could be another one of those hallmark signs. Hey, these SPAC things are absurd. They're almost like taunting people by naming them absurd names. Almost just out of fun. And so it's I think well overdue for some clamping down there. I wanted to quickly talk back to the patience thing, Adam, because you gave a nice call out to our the stability that our defensiveness back last March when COVID was hitting and what that did for our clients, at least in that episode. But you really got to take a step back. There have been times that we can go back in history, not too far history actually, and see like periods of 15, 20 years even where treasury bills, cash basically did just as well as being in the stock market. So for example, at the bottom of the housing bubble in 2009, all the way back to 1996, you've been just as well off just holding cash and would have missed two big bubbles along the way. Also period 1965 to 85, that period of time, the stock market did no better than holding cash. And interesting, that's kind of a similar period to what we're in right now, where stocks started in the 60s, very high valuations, low inflation, but suddenly moving higher inflation, not dissimilar to the environment we're looking at now. So patience really needs to be measured on years, not months or weeks. There is a real compelling reason to look at in years, not to say that either of those periods I just mentioned meant you should have been out of the stock market for that full period. It's just to say that patience can have dividends that literally save years worth of progress that can go up in smoke in an instant.
Well, really well said. I think it's a lot like anything in life, really, when you're creating true value. Very, very few things are an overnight success. It really just comes from application of hard work, consistency, and perseverance. And you're just sort of giving an investing analogy of that, John, right? Which is you've just got to, you've got to be data driven. You've got to be empirical. You've got to have a context of history and look at when things are overvalued or undervalued and what's most likely to happen next. And to be honest, we have very few investors around today that do that anymore because we've had such a long period of time where stocks have only gone up. It's really become just sort of an operating belief for so many investors. And of course, that's the whole Roach Motel model. Where it feels great while it's going on, and you go into the motel because it all sounds fine. But once reality sets in, those are the people who are going to be damaged the most. So, anyways, as we wrap up here, real quickly, Mike. We talked about dealing with FOMO last week. I know we've had some conversations in the ensuing week of some additional calls you've had with investors who are kind of wrestling with this sense of my brain is telling me to do this when I'm being logical and rational, but I'm looking at my family members who are throwing caution to the wind and just being long this market and seeing the money that they're making. And people are beginning to feel that siren song of wanting to abandon the logic and just jump in onto the party, which generally tends to be a hallmark of the very late stages of a mania or a bubble. What's the latest status of that? Are you still seeing that rage? Is it tamping down? Because you guys are a good barometer, I think, of where sort of sentiment is right now with investors.
Yeah, it's even worse this week, I'd say, than last week, and it's it's slowly been building ahead of steam for the last 4 months, in my opinion. I mean, not to say the last 4 years haven't had pockets of it, but it has been absolutely relentless the last 4 months or so. Since I guess about the turn of the year or just before that. And this year, this week, a little worse than last week. And we were talking to people, they're really psychologically pressured. The discussion about patience earlier. It's true, that's what exactly needs to be done by the individual investor or the professional money manager. But the sad thing is central bank policies are using that against us all. It's essentially like a strategy, a psyop to get you uncomfortable, and it's working. And that's the really sad part about all this. If we're right and this market does drop hard at some point, and it's hard to imagine that it won't from these valuations, a pullback of 50, 60, 70% even, wouldn't even get us to an undervalued level. Of course, we can't predict that. But if that happens, can you imagine, not just the pensions that are underfunded, and there's going to be problems there. The public is all in. The public is all in. Earlier, Bill said that the retail is back, the mania is back. It is. I mean, if you take a look at fund flows, there's more flows in the last, 5 months than there has been in the last decade or so, if you look at the data. So, yeah, we're reaching a fever pitch. People are just choosing to be more aggressive. As we've said before on these videos, we can help people be more aggressive with a safety net if that's what they really want. We don't think that's what should be done here, but we can do that. And we're trying whatever we can to get people to just be comfortable to sit through this period, because what's needed is patience. And it's sad that our own emotion is being used against us here as a monetary and psychological tool.
Yeah, well, kudos to you guys for playing that role. I know it is not easy. You guys take a lot of slings and arrows for being the disciplined ones and trying to be the adult at the party. But it has an awful lot of public value, both on these videos and with the folks that you're talking to individually. All right, guys, so everybody viewing this, a reminder, this new Wealthion channel is off to a great start, but it needs your help. If you have not subscribed to the channel yet, please take a second and just click the subscribe now button below and the little bell icon next to it. And that way you'll ensure that every time that we do one of these new videos, you get alerted about it and you're not in danger of missing any of these things going forward. While you're down there, click the like button. Again, if you want to figure out which guests are coming on the program next, if you want to learn that early, follow me on Twitter at @MenloBear and send me your speaker suggestions there. And then lastly, if you haven't done this, take everything that Bill and Mike and John said to heart. Spend some time developing a plan with a financial professional who understands all the risks that we've talked here. If you've got a good one already, great, stick with them. But if you don't, or you're interested anyways in hearing their point of view, John and Mike and the folks at New Harbor Financial, reach out, schedule a consultation with them. They'll sit down with you, they'll hear about your whole financial situation, and they'll just give you their best advice. You don't have to work with them, it doesn't cost you anything. If you haven't done that yet, take advantage of it, or if it's been a while, do it soon, because I was actually shocked that Bill, basically when I asked him on the timing perspective, he said, yeah, I think something's going to happen this year. I wasn't necessarily expecting it to be that close in his estimation. So if you're interested in figuring out how to set up one of those free consultations, just stick around to the end of the video. We tell you how to do it. It only takes you like 15 seconds or so. And with that said, folks, thanks for watching. We've got some great guests lined up for the next couple of weeks. And John and Mike, no matter what the markets do next from here, we'll be tracking it together on this program. See you guys next week.
Bye, Adam. Thanks a lot. See you soon.
Yeah, see you next week, Adam. Thanks.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market will always take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.